So I'd like to start trying to put all of this together in a little bit of a case study. So I want to talk about two couples. We have a theoretically older couple and then obviously a theoretically younger couple. So if we look at the older couple, let's just meet them. They're 68. They're living on $100,000 a year of after-tax income, and they've got $2.2 million as their investment base. So they want to preserve capital. Now our younger couple, I don't want to terrify you, they don't look quite as attractive as the, so this is the younger couple. Now to be fair, they're sort of cute. He's a professional ogre, and you may not realize it, but if you Wikipedia Shrek, you'll find out that his birthday, his 40th birthday is tomorrow. So, seriously, you know, he might prefer to get a telegram or an email or a card or something. So they would like to retire at 60, he'd like to be nice, he'd like $150,000 a year of income, and they've got $1.3 million of investments. The concern here is when we do projections for them, what rate of return should we assume is realistic for them? Because they're sort of looking at this as their model for how much money they can afford to spend based on the savings or the capital that they either have or that they're going to have. So let's take a look at real returns. We looked at that original balanced portfolio back to 1925, and a 4% real rate of return on a balanced portfolio is exactly the return. But in the last 12 years, as I said, the return has been zero. For our clients, it actually has been that 4% a year. The question is it reasonable to assume it will be that going forward 5, 10, 20, or 30 years, depending on your time frame? So let's take a look at the way our planning process works. Clients are either in an accumulation phase, they have current assets, they need to accumulate money till they retire. They then need to draw an income, which ideally keeps pace with inflation on an after-tax basis. And that means their assets ideally keep pace with inflation as well. And then ultimately, there's going to be capital left in an estate. So all the planning relates to either wealth accumulation, retirement income planning, or estate planning. They're all basically connected. So let's imagine our Shrek couple. This is what they might need to save if they were earning a 4% real rate of return. It would grow up dramatically if they only made a 2% real rate of return. And for our retired couple who can't save more money now, they're already retired, their estate would shrink dramatically if their rate of return dropped to 2% a year. So we're going to look at the things that they might do to eliminate or reduce that risk. So let's look at Shrek's savings for starter. At 4%, let's assume that to meet his objectives or the couple's objectives, they need to save $50,000 a year. If they make only 1% a year less, they almost have to double that, or they more than double it to 109, and they quadruple it to almost $200,000 a year, which is, let's assume, an impossible number to save if they only make 2% a year on their assets. This is 2% a year after inflation and after fees. Now, what can they do? Well, if we assume that they can maybe split the difference and earn a 3% rate of return, retire 1 year later, and agree to leave a lower estate value, they can go back to saving $50,000 a year and still hit their targets. So a large part of retirement planning is to make sure that all the other assumptions are considered outside of the rate of return. One of the issues that affects people, obviously, is, and I was going to ask you this, I'm sure you're going to, I think most of you are going to say the same thing, but if I asked you, what is the first, when you get a statement, whether it's from us or anybody else, what is the first thing you look at? Is it not the number on the statement? And if the statement shows a rate of return, is that not the second thing you look at? So we look at the number, how much is in the investment account, and we look at the rate of return. That seems reasonable and rational. The problem is it creates issues. So what I'm showing you here now is what are the rates of return for our clients in the last 4 years. I'm going to start with 2006, which was a terrible year, as you know, where the average balance fund probably lost 20%. And nevertheless, our accounts were down 6.7, so less than the market, but still they were negative. Decent year the next year, 15%, 9.6, and 1.6. So let's look at this, how the client might react to these statements if, say, they were only looking once a year. So obviously they're going to have a sad face at the end of 2008. They're going to be positively euphoric at the end of 2009. At the end of 2010, they're going to be happy. They're not euphoric, it's under 10%, but they're happy. And now they're very nervous about the fact that it's 1.6% for 2011, because their response is based on these numbers. Now, they look at the price, and there's nothing we can do about it because that's what we have to report on. So let's imagine we then look at the cash flow. That same portfolio we're looking at has this yield each year, and that yield looks pretty stable. In fact, if I convert the yield into dollars and cents, it looks like this. This is the portfolio rising and falling in dollars and cents. It's down 140,000 in the first year, up 300, up 200, up 35 in the following 3 years. If I look at the cash flow, though, this is the sustainable cash flow, the rents, the dividends, the interest combined on this portfolio for the client. They look like this. They go from 114 to 121 to a 127 to almost 130. So what I'd like to do now is just take away the price and change the way this looks to frame a different way of valuing your portfolio. So let's just look at the cash flows. They look fairly impressive. Let's just imagine that they weren't the cash flows from a balanced portfolio, they were simply the cash flows from rental income on an apartment building, because they could easily be that. Would price matter if this was the income from an apartment building? Would you actually be looking at year-end assessment values or appraisal values and being happy or sad depending on how they turned out? Or would you just be happy to know that you were getting $10,000 a month of income and it was growing at some certain level each year? So the hard part of building a balanced portfolio is we react, we're all the same this way, because we respond to price, which we don't control, and we don't respond to cash flow, which in some cases we simply don't know. Now, just in case you're not aware, we measure the cash flow for all of your portfolios on an ongoing basis. So we should do a better job of communicating that with you, but if you want to know how much income is coming in every month in your portfolio, we have that information. So I want to switch to, just to wrap this up, to what I talked briefly about last year, which is what is the ideal tax haven? Now, the way I would look at it, it's someplace that has low tax rates, great health care, great weather, and good food and wine. So unfortunately, obviously, we don't live there. We live in Canada. So we now need to compare how Canada stacks up to an ideal tax haven. Well, if we start, we actually do have relatively low tax rates, as I'll show you in a minute. We have decent health care. Maybe not the greatest, but we have decent health care. It's pretty good. We have very grim weather, and of course we have Timbits and ice wine. So we have 2 out of 4, but we have maybe the important 2 out of 4. So let's take a look at reducing taxes, because if we're trying to make sure that clients preserve capital, one of the ways to do it is to increase their income by decreasing how much is, because we're talking about their after-tax cash flow or their spendable income. So typically, a client like this, retiring on $10,000 a month after tax, would draw money from registered plans and CPP. Maybe they are also eligible for old age security. We can generate income on what are called insured or prescribed annuities, preferred shares, real estate, and equity income. All of these are designed to generate cash flow. Now, this percentage you're looking at is the percentage of each of these that is actually taxable. So if I combine them all together into a pie, they look like this. There's $40,000 of tax-free income for this couple and $80,000 of taxable income. That's $120,000 a year. They can income split pretty well equally, and their tax bill is going to be $6,000 each on $120,000 of income. And that's a 10% tax rate, which is a very, very efficient tax rate. You can go to lots of places and be paying a lot more than that. So if we take a look at it, why does this work so well in Canada? First off, certainly for older clients, prescribed annuities are very attractive alternatives to other fixed income investments such as bonds or mortgages because of the way that they generate cash flow, but mainly because of the way they're taxed. Dividends are also taxed at half the rates of interest income. Rental income is partially tax deferred. We distribute maybe a 7.5% cash income on Spire to our clients, but at least 2.5% to 3% of that every year is tax deferred, so it's not taxable in the current year. And obviously individuals can income split. If they have holding companies, if they have RIFs, if they have pensions, they can income split, which reduces tax as well. So we're in a very nice tax haven. So if we look at these two couples, then the older couple can reduce spending after 80. That's one alternative to allowing their estate, where they can just decide to leave the kids no money. That would be an absolutely, completely reasonable alternative. They can use prescribed annuities we talked about. They can downsize their home. They can defer property taxes. But I believe the best defense for them is to focus on the cash flow that's generated in a portfolio. I believe that that will work out the best for them in the long run. And for the younger couple, they can retire later, they can work part-time, they can hope, and I believe that this is the case, that long-term returns, especially for equities, will return to the mean. I would be very surprised if that's not going to happen. Interestingly, if they generate cash flow, I don't think the younger couple shouldn't have cash flow in their portfolio. They should. They should be using the cash flow to reinvest and dollar cost average through their portfolio. That's a very effective way to grow and build a portfolio. And if they're, in this case, because Shrek is a professional ogre, he's allowed to incorporate. So as a result of that, if he does that, they can keep their tax rate on their investment portfolio to less than 10% with some reasonable and proper planning, which means income tax will not diminish the growth of their wealth in their company, in their professional corporation. So to put it together, why not worry? Well, first off, you are going to build a plan. You are going to be able to keep your tax bill as efficient as possible and relatively low. Well, at least with us, we are going to focus on a cash flow portfolio. And so when you put it all together, my issue is that even though we lived in very challenged circumstances, I believe that you'll easily be able to hit the targets, you know, the 3 to 4 to 5% real rates of return that we hope you can achieve and we have achieved in the past. So those are my comments that I wanted to touch on tonight.